The waiting, they say, is the hardest part. The toughest lesson I have learned since I began picking my own stocks is not buying a business once you fall in love with it. It really speaks to a core principle of this channel, and that's don't overpay for a stock, or in other words, buy at a reasonable price. And what we are discussing today are 4 businesses I have fallen hard for, but they are trading way too damn high. Welcome to The Quality Investor. 3 of these businesses have been on my watch list for a long time, yet I have never felt good at the price that they've traded at to justify jumping in, and that has probably cost me some return. I've definitely watched them go up. The 4th is a business I bought a couple of years ago, and I desperately wanted to add more. But again, have never felt the price was justified. I also believe this 4th business is one of the top 3 to 5 businesses on earth. But before we get into it, please like this video and subscribe to the channel. It only takes a second, helps us grow, and you can stay on top of all the quality businesses in the market. So before diving into the list today, I want to share why I fell in love with these businesses. Each is, at best, dominant in their respective industry, and at worst, a duopoly. Each, with one exception, is capital light, meaning less reinvestment of earnings back into the business to sustain growth and more earnings left to owners. Each have a brand name that either connotes high status or consumers love without question. Each have an operating model that prints money. I'll get into each of these aforementioned points as I discuss each business, as well as what I think makes each so unique. I'll also discuss what price point I'm waiting on for each of these businesses to trade at before I'm willing to pile cash into the investment. And without further ado, let's get into it. First on our list today is Costco, and this is one of the businesses that I own. I firmly believe this is one of the top 3 to 5 businesses in the world. They have a stunningly simple yet very effective business model, that operating model that just prints cash. You need a membership to go to Costco, and that membership is basically free money. This chart here demonstrates what I'm talking about. It's slightly dated, it goes through 2023, but the fundamentals remain the same. You can see the membership fee revenue growth over the years since 2000 from under $1 billion to up to close to $5 billion. I believe today it sits at close to $4.8 billion, and how that's a huge component of their operating profit. So this is massive operating leverage for Costco. And that's important because they're a discount wholesaler, meaning they're going to have very tight margins when it comes to the sale of the actual products that they sell. But fundamentally, Costco is very sound. They reliably grow their revenue. They pay a very healthy dividend. But this is the capital expenditure I was talking about. They are capital intensive, and that is because as they broaden into new markets, they have to invest a lot of capital to build warehouses. But they generate so much cash that it's very easy for them to fund these projects directly from their operating cash. And you can see their decreasing debt to equity ratio over time, and their cash has generally increased while their debt level has remained relatively the same. The other factors Costco is going for is its dominant market position. Now, you can argue that Walmart is a competitor, or maybe even Amazon, possibly Target, but they don't offer the type of bulk and pricing that Costco can offer. Costco is slightly different in that regard. First, you need a membership, which filters for a higher level of consumer, but that membership also unlocks very good pricing deals that you simply cannot get at the other retailers. And Costco is almost religious when it comes to keeping their prices low. Again, see that video where I talk a little bit more in depth about Costco's pricing strategy, but their relentless focus on keeping prices low and supporting their customers has created a loyalty to the Costco brand that is nearly unmatched by any other business. But Costco trades at $982.09, which is still very high for me. Costco's share price has grown relatively slower this year than it has in the past. It's up nearly 8%, which is a little bit behind what it's been doing the last couple years. Despite that, it still has a PE ratio of 55.7. and a forward PE of 58.8. So this business trades at a very high premium. And that's always been one of the problems with Costco. It's such a good business, such a sound operating model. The market completely recognizes this and thus trades at an extreme premium. The growth that I have forecasted and the analysts forecast for Costco isn't anything special either. So you'd think with a PE ratio of 55.7 that you're going to be growing 20% a year. Well, Costco's not there, and Costco won't get there anytime soon, again, just due to their size. I have their revenue growing from 6.5% on the bear case up to 10.3% on the bull. Their free cash flow I have growing from 7.2% on the bear case up to 14% on the bull case. So not a lot of growth, and you can see that reflected here in the discounted cash flow price. $448 up to $753.64. Now, Costco does pay a very good dividend, and it's a growing dividend. I have their dividend growing 11% on the bear case up to 13% on the bull case. And you can see that dividend discount price here is very attractive, which is probably the only thing pushing Costco's valuation up right now. And their exit multiples at $663.77. The comps here are Amazon and Walmart. So without any margin of safety, Costco's buy price is at $861.86. Now, if we're being realistic here, Costco, while they do go through drawdowns here and there, they're never that extreme. And this is one of the very few businesses that I'd be willing to buy, even if it doesn't fall into these margin of safety zones. I'd be willing to pick up more shares at Costco if it falls down below $900. This is a business that has a very good growth trajectory. While that growth is not going to exceed 10%, they're steadily opening more warehouses, not only in the US, but around the world. They're one of the few US retailers that has succeeded internationally. So their total addressable market is essentially the globe. So they're going to continue to grow for a very long time. And that operating model isn't going to change. They're always going to have membership fee revenue. It's going to provide them free money. More members increases their operating margins. We as investors just have to be patient, wait for that one bad earnings report, a general market pullback. Costco will become a reasonable price again. If it dips into these margin of safety zones, that'd be great. But even below $900, I do think Costco would be worth adding to. Moody's is just another fantastic business that's been on my watch list for a few years, but I've not found a good entry point yet for me to buy a large stake in it. I've always felt it was too high. Yeah, as you can see over the years, it still has returned quite a bit, 21.3% per year in the last 3 years. And on a 1 year basis, it's returned 15.9%. And this year alone, in 2025, it's up 7%. Now, Moody's doesn't grow their revenue as fast as some of the other businesses on this list. However, they do grow their free cash flow. And a big reason for that is because of their very high margins for the type of business they are. They are the second half of a duopoly, along with S&P Global, and that they are a rating agency for debt. But here's the interesting thing about that particular market. First of all debt that's issued by law must be rated. There's also Fitch, which is a third rating agency, but they're not as big as S&P Global and Moody's. Yet combined, they account for 94% of the entire debt rating market. And the reason for this is that they have what they call regulatory recognition. It's the most significant part of Moody's moat, and it's considered a nationally recognized statistical rating organization by the U.S. Securities Exchange Commission. This recognition basically creates one big giant barrier to entry. So essentially, all debt that gets issued will get a Moody's rating. So there's always going to be a baked in demand for their product. So that's one aspect of their business. The other aspect is they're incredibly capital light. They rate debt. They don't sell a manufacturing intensive product. They don't build buildings like Costco. So their capital expenditure is extremely small compared to what their net income is. For example, their CapEx as a percent of NOPAT is around 15%. Compare that with Costco's CapEx percent of NOPAT. Costco's at 67%. So for Moody's to sustain their growth, they don't need to reinvest a lot. Look at that free cash flow available to investors at the end of the day. I alluded to it earlier, but Moody's brand is one of high status. To have your debt rated by Moody's confers legitimacy upon whatever debt issuance you have. It seems insignificant, but it really matters. So Moody's has an operating model that is basically required by law, a high status brand, very capital light, and because of that, it trades at a premium. So what kind of price would I be willing to buy Moody's at if not at $506.63? Moody's is now at $505 a share, giving them a PE ratio of 43.6 and a forward PE of 34.9. The market is essentially pricing in 10.8% free cash flow growth over the next 10 years for Moody's to get to that price, and I myself am pricing in just over 10%. You can see my DCF prices on the bear, base, and bull case here from $401.18 on the bear up to $585.37 on the bull case. That reflects free cash flow growth of 7.8% for the bear case all the way up to 12.3% on the bull case. Their dividend discount pricing model here goes from $412.07 on the bear up to $659.28 on the bull case. They do pay a very good dividend, and I have it growing from anywhere from 8% to 12% over the next few years. And they have an exit multiple of $434.25. So this gives us a buy price for Moody's at $484.45 with no margin of safety. The 10% margin of safety, that's a buy price of $436. So I would want to wait for Moody's to come down to below $440 before I'd be comfortable adding it into my portfolio. I believe this is a great stock and there's a lot of good potential here, and Moody's is probably the business right now closest to a buy price of all the businesses on this list. But in my view, at $505, it's still a bit overvalued, a little bit rich, and we need a drawdown before Moody's is now trading at a reasonable price. FICO is another business I absolutely love. Yet they've come under some fire recently. We'll get to that in a second. But FICO has done nothing but consistently grow its business over time. Much like Moody's, they are a stalwart in the consumer credit rating business. Any consumer that applies for anything, from a credit card, auto loan, mortgage, will need to know their FICO score. And of course, the FICO score is from Fair Isaac. They essentially have a monopoly over credit scoring for consumers. Now, that may or may not be about to change. We shall see. But that monopoly has turned Fair Isaac into a cash printing machine. Since they're essentially selling a service, their operating model basically has very high operating leverage. So the more they scale up, the more profitable they become. And you can see that reflected here in just their steadily growing margins over time. And yet another feature of the software industry is they don't have a lot of high capital expenditure. You can see that they barely reinvest anything back into the business, yet have grown like crazy. Their capital expenditure as a percentage of their NOPAT, or net operating profit after taxes, is a minuscule sub 5%. Yet we can see their 10-year returns, 33% per year over the last 10 years, 57% per year over the last 3 years. And actually, you can see that here reflected in this chart in the bottom right, market capitalization. And this is what has made FICO so tough over the last few years, because they haven't just consistently grown like a Costco or even a Moody's. They've exploded since fiscal year 2023. So you could argue that they might have been a little bit overvalued here, but now, even at $1,600 with the massive drop in the market they've suffered over the last few days because of what the Fed's announced, I believe it was something like a 16% drop after that announcement, they're still trading very high, as we'll see here in a second. It was announced earlier this week that Fannie Mae and Freddie Mac are allowing lenders to use the Vantage Score 4.0 for mortgage underwriting. And of course, the market reaction to this, as I said, caused FICO to drop a pretty significant amount in the stock market. And the concerns over this is it's the end of monopoly. Vantage Score is cheaper, so that it's going to reduce cost for lenders. And that Vantage Score actually has a more robust model to produce credit scores, which creates a larger pool of mortgage eligible consumers to rate scores for. The point is, the market's definitely seeing this as a direct hit to FICO and their market position. Now, of course, FICO didn't get where they are today because they sat around enjoying the fruits of their labor. They've adapted, and they're doing that right now. And they're saying that they're incorporating buy now, pay later loan data into their models in order to stay competitive and increase their pool of eligible candidates. The other aspect I think FICO has is actually similar to social media. When thinking about social media, think about the various platforms that are out there. YouTube is essentially the singular platform for long form video content. TikTok, while YouTube is now making inroads into this, is still seen as the singular platform for short form video content. X is the singular platform for the digital town square, where ideas, for lack of a better word, are discussed. And Facebook is basically the singular platform for a person's sort of personalized online profile. And the reason for this is network effects. Each of these platforms provide a unique way of presenting yourself online, but only one of them can dominate their respective niche. And that's because once one of them reaches a critical mass, they simply have the network effect to compound their user base. It doesn't make sense to go to a competitor for Facebook because nobody's going to see you. And that's how FICO operates within the credit scoring industry. They are the industry standard. Lenders trust their scoring for its reliability and predictability for a consumer's ability to repay their loans more than any other scoring system out there. That gives them an entrenched position in the market, and they have that high status, similar to Moody's. In fact, I can see a situation where lenders will want both scores to assess a consumer's ability to repay their loans, thereby making FICO necessary no matter what. So I see this as a short-term impact to FICO, but long-term, I don't see how FICO will be hurt by this. In fact, I can see them actually getting more entrenched in their market position. That said, they're still trading at over $1,600. So let's see what price I would be comfortable buying FICO at. FICO trading at over $1,600 a share is still at a massive 70.3 PE ratio and a forward PE of 65.1. The market is saying that FICO is going to grow their free cash flow over the next 10 years at 18.7% per year. I'm a little bit more conservative at 14.7% growth. And remember, this market projection here is after the huge drawdown of over 16% with the Vantage Score announcement. You can see the DCF prices I have here for FICO on a bear case at $865.70 up to $1,683.61 for the bull. This is based on revenue growth from 9.9% up to 14.3% and free cash flow growth of 11.2% all the way up to 19% for the bull case. So despite this recent news, the market itself is quite bullish on FICO. I am too, but I am still being much more conservative in my growth projections. I think FICO's had a massive run up the last couple of years. You can see that their PE ratios are far above their 5 and 10 year averages. But even with the recent drawdown, FICO is a little bit too rich. I would like to see FICO come below 1250 before I even consider buying shares in this business. And who knows, it might just continue to race up and I might miss the boat yet again at a $1,600 valuation. But maybe in the short term, this news will continue to put downward pressure on FICO's share price, and hopefully we'll get a good entry point into this very fine business. The final business on this list is Netflix. I have not talked about Netflix much on this channel, but Netflix has clearly positioned itself as the market leader when it comes to streaming content. Now, I've talked before about YouTube and how they're the most watched streaming platform, but I consider Netflix and YouTube as very distinctive and different entities and not direct competitors. Netflix, of course, licenses content from other movie studios as well as produces their own content. Very different from a YouTube creator going on and uploading their own videos. Yet Netflix's growth over the last few years has been nothing short of remarkable. They became free cash flow positive for good in fiscal year 2022, and that has launched their stock price into the stratosphere. You can see the 3 years annually, they've returned 89%. On a 1 year basis, they returned 86%, and year to date, they're up 41.6%. So at $1,262 a share, yes, Netflix is a little bit expensive right now, although this is a business I would love to own. One thing that's interesting to me is despite the cost involved in creating content, they're a very capital light business. A big reason for this is that the money required to produce their original content, as well as licensing content from other producers, is not capitalized upfront as an expense. It's recorded as an asset, specifically an intangible asset. Look at the size of their intangible assets compared to their total assets. 61.5%. The size of their intangible assets is at $32 billion. So they capitalize their content creation as an asset and then amortize that over time. It's amortized into cost of goods sold. So the massive spend they have on content creation doesn't hit their bottom line all at once. It hits it over an extended period of time. So by capitalizing this as an asset, this gives Netflix invaluable IP or intellectual property that it can now show for many years. Netflix is pure streaming platform, whereas other platforms that stream like Amazon Prime, Disney Plus, they're all arms of a larger company. So Netflix's original content is what really sets it apart, and they produce more original content than any other platform. By 2024, they had released 234 titles, which was 44 more than Max, its closest rival. And like Google is synonymous with search, Netflix has become synonymous with streaming. You never hear people say, let's make it a Prime night. They always say, we'll do a Netflix night. And this is due to the fact that its brand has built in a very loyal following. They have nearly 250 million subscribers globally, and their steady price increases have provided high operational leverage for Netflix. Another thing Netflix has done is taken market share consistently from other streaming services, even today. So you can see in 2022, Netflix had 38.6% of the original film market share. Netflix has been making original films for maybe a little over 10 years. Disney, the 2022 leader in original film market share at 40%, has been making films since the 1930s. Yet in 2024, Netflix owned 50.6% of the market. Disney, on the other hand, has shrunk considerably to 16.2% of the market. Prime is definitely an up-and-comer here, but the point is Netflix is dominating market share when it comes to the original film market. When it comes to the market share for original series, it's a little bit of a different story, but Netflix still is the leader. In 2022, Netflix had 46.2% of that market. Today it's at 36.4%, still number one, but Paramount Plus has made some significant inroads to Netflix's market share, sitting now at 17%. I fully expect Netflix to continue to adapt. And in fact, one area that I think they're really going to start to excel over the next few years is in live events. They've already jumped into that foray with boxing events, wrestling. Of course, the biggest cash cow out there, NFL football, last Christmas. We should expect to see that to continue with more live sporting events. However, Netflix is expensive, so at what price would I be willing to buy this business? Netflix is trading at over $1,250 right now. That gives them a PE ratio of 63.1, a forward PE of 50.8. It is a little bit higher than their 5-year average, but quite below their 10-year average. And again, they really became super profitable within the last 5 years. The market, however, is pricing in free cash flow growth over the next 10 years of about 20.3%. And I'm pretty much right there on my base case at 20.08%. And you can see the DCF prices I have for Netflix are $845.08 for the bear, up to $1,635.90 for the bull. They don't pay a dividend, and I don't have an exit multiple comparison simply because their comps, which would be businesses like Disney and Paramount, it would make their valuation average so low that at no point would I be willing to buy into them. Now that said, without any margin of safety, I have a buy price right around what Netflix is trading at right now at $1,233.20. With a 20% margin of safety, a buy price for Netflix would be $986.56. So I would be comfortable buying Netflix once it comes down below $1,000. But anytime before that, it's just a little bit too rich. I do think they have a strong growth trajectory, but right now there's trading at a premium that's just too much for me to believe I would get the type of return that would outpace the market at today's price level. So these four businesses are all examples of excellent business models, strong future growth trajectories, but all of which are trading at a very high valuation currently and require patience by the quality investor in order to buy into them. 3 of these businesses I've wanted to own for a while, one of which I bought a long time ago and want to add more. But this is where the test of patience comes into play. And inevitably, all of these businesses will have drawdowns. It's just a matter of time. But once they do, that's when it's going to be time to pounce. And you know what? As we've seen, these opportunities will not last long when they do have drawdowns. So you have to be ready to pounce fast. And that's why it's smart to know at what price you'd be willing to buy into these businesses. Thank you for watching today's video. And if you've made it this far, go ahead and subscribe to the channel. Thank you and happy investing.